Hi, my name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. This video will discuss the tax implications of death. Benjamin Franklin once said that in this world, nothing can be said to be certain except death and taxes. The death of a family member or loved one is not something anyone likes to think about or prepare for. However, it is essential to know the steps that must be taken regarding taxes when it occurs. Being prepared for these challenging times can ease the burden on you and your family when taking care of the taxpayer's final tax return. Let's take the case of Mike. When he dies, his legal representative or executor is required to file a tax return on his behalf. When he dies, he is deemed to have sold all of his property owned at the time of his death at market value. The sale is deemed to have occurred immediately before his death. Property left to his spouse or common law partner moves to her at the tax base of the property. That is, it moves at cost. For example, non-registered investments, vacation properties, rental real estate, private company shares, and other taxable capital assets can generally be left to surviving spouse upon death with no capital gains tax immediately payable. This provision automatically applies. However, his personal representative may elect out of this provision if the rollover provision is elected out of. The property is deemed to have been disposed at the market value and there are tax implications. The election may be made on an asset by asset basis and it may be beneficial in situations where he had losses such as non-capital or net capital loss carryovers or other credits that would otherwise not be used. A terminal or final return must be filed for the period from January 1st in the year of death to the date of death. In addition to any amount discussed above, the final return must include all periodic payments that were earned prior to his death, including, as example, interest, rent, and salaries. Accrued amounts to be included in income are determined on a daily basis. His representative can also claim items such as charitable donations and medical expenses paid within the last 24-month period. These items will be applied to the final tax return and result in reduced taxes owing. Let's discuss rights or things return. You see, rights or things are defined as amounts that would have been included in his income when they were received if he had not died. These amounts can be reported on a specific tax return known as rights and things return. Filing this special return allows for doubling of some income tax credits. Some of the income may even be taxed at a lower rate because of graduated income tax rates. That is, the lower rates that are applied to personal income. Some examples of rights or things are matured bonds, dividends declared before the date of death but not received, salaries, commissions, and vacation pay owing for a period prior to death but unpaid at the date of death. An election can be made to include the value of the rights or things in a separate tax return. If the rights or things are transferred to one or more beneficiaries, such as his spouse or kids, they are reported in the beneficiary's income tax return. Suppose the rights or things do not automatically transfer to other beneficiaries under his will. In that case, it may be beneficial to include them in the income of his beneficiaries who have little other income. That way, the overall tax will be very low. If held an RRSP or RRIF when he dies, he is deemed to have received the plan's value just before death. One way around this type of income inclusion is to transfer the plan to a spouse, common law partner, or a financially dependent child or grandchild on a tax deferred basis using certain registered plans. You see, while withholding taxes during the lifetime helped him to avoid surprises and hardships at tax filing time, payments from RRSPs and RRIFs at death don't normally receive the same treatment. Should have considered life insurance to cover taxes or equalize entitlements for plan and estate beneficiaries. I know talking about dying can be uncomfortable, but death is a part of life. So too is income tax. And with a little planning, you can reduce your lifetime tax payable and minimize the potential tax payable by your estate. Make sure to discuss the tax strategies with a chartered professional accountant. Thanks for watching and see you in my next video. If you want to be notified about my new tax updates, please consider subscribing to my YouTube channel.